Hi folks, welcome to today's Bobcast. The topic of today's Bobcast is how taxes work on investments. I'm Bob Benny.
I'm Jesse Thompson.
We're with Bob Benny Wealth Management. We're both certified financial planner professionals here in Lincoln, Nebraska with Bob Benny Wealth Management. And let's get started on talking about taxes on investments.
Yeah, so this is kind of one of our most frequently asked questions on how taxes work on your investment account. And particularly what we're going to get into the most today is how taxes work on non-qualified or non-retirement accounts, because that's kind of the most confusing ones, right? Like, we know for the most part people get and can understand how taxes work on qualified accounts or retirement accounts. So we're talking your IRA or Roth IRA, right? So the taxes are deferred on those. How they work is a little bit different. So on an IRA account, the money that you put into the account, you get a deduct on your taxes, right? The growth grows tax-free. Then when you go to take withdrawals and money out, every penny is taxed.
It's the same thing as a 401k or a 403b that you have a retirement account at work.
On a Roth IRA, you use money that you already paid taxes on to contribute to the Roth IRA. You don't get any kind of tax deduction or anything like that up front. The money grows tax-free, and then when you go to take the money out, the money's not taxable at all as long as you wait till you're 59 and a half.
So those are qualified accounts. What we call, and what the industry calls non-qualified accounts, means they're ordinary accounts, brokerage accounts or that sort of thing. And there's three different types of taxes that can apply to these accounts. There's taxes on dividends, there's taxes on realized capital gains, and there's taxes on interest if there's bonds in the account, taxable bonds in the account. So if there are individual stocks or mutual funds or ETFs that pay dividends inside of those investments, annually, in a non-qualified account, you have to pay taxes on the dividends at ordinary income tax rates.
If there are capital gains in the account, so that means that you bought something and it's grown, and then it was sold after it's grown, you have to pay taxes on the growth. And the amount of taxes that you pay on the growth depends upon how long you held that investment for. If you held the investment for less than a year, you pay short-term capital gains, which is going to be regular ordinary income taxes on the growth. If you held the investment for longer than a year, then you get special income tax rates on that growth. And
called long-term capital gains rates.
Depending on what your adjusted gross income is, it's either going to be 0% if you have a low adjusted gross income, or it's going to be 15%. For the majority of people, it's going to be 15% because that's the biggest long-term capital gains tax bracket. Most people fall into that category. And for people who are super, super high income, the most that they're going to pay is 20% on those capital gains.
So in that example, super, super high income, somebody that's in the 35% federal income tax bracket, because they make $1 million in income in a year, let's say, they're only going to pay 20% on capital gains tax rates. Mm-hmm. The one thing I want to point out about the capital gains, in these non-qualified accounts, you're only going to pay taxes on realized capital gains. Mm-hmm. The difference between realized and not realized is if you have an investment that, let's say you invested in McDonald's stock, and you invested $10,000 and it grew to $20,000, you don't have any gains until you sell it. You have an unrealized gain of $10,000, but you don't have to pay any taxes on that increase in value until it's sold. That's called an unrealized gain. So,
and if you have losses, so if something is sold at a loss, you can offset the gains that you have on maybe other stuff that you had to sell at a gain.
Yes. And then interest, like interest from a bond, a corporate bond, or interest in a money market, or interest from a CD inside of a brokerage account, you have to pay taxes on that interest at ordinary income tax rates. So there are different ways of trying to manage the taxes that you have in non-qualified accounts by trying to minimize the interest or minimize the things that are taxed at ordinary income tax rates, and trying to increase or trying to make any taxes that you have to pay be at capital gains tax rates,
Long-term
which are so much
capital gain
lower.
tax rates.
So, and that's one of the things that we, with our accounts that we manage for people, try to keep on the lookout for is the tax consequences of any investment changes. And maybe if we're thinking about selling something, we look and make sure that it's been owned for over a year so that they're taxed at the lower long-term capital gains tax rates rather than ordinary income tax rates. So anyway, that's our Bobcast for today. Thank you for watching. If any of this information seems to be of interest to you, please share it with your friends. Share the video with your friends. Please like us on, what is it?
YouTube.
Yeah, like us on the YouTube. And you can always call us or email us with any questions that you have. Thank you very much and have a blessed day.